Right now, as of June 2026, Melbourne has more homes sitting on the market than at any point in the last 12 years. Not a small jump, not a blip. According to Domain's Market Insights report, released just days ago on June 5th, the number of houses listed for sale in Melbourne is up nearly 16% compared to this time last year. Supply has hit its highest point since 2014. And in the same week that report dropped, auction clearance rates across all capital cities fell to 54.7%, the lowest May result since 2019. That's a lot of numbers coming at you fast. So let's slow it down and talk about what's actually happening here, why it matters, and what it means depending on whether you're buying, renting, selling, or investing. Because this story is bigger than just a headline.
To understand what's going on, you have to understand the timeline. Back in 2025, the Reserve Bank of Australia started cutting interest rates, 3 cuts in total. And when that happened, buyer confidence came back, prices ticked up, and Melbourne's property market was slowly stabilizing after a rough couple of years. Then 2026 arrived, and everything reversed. The RBA turned around and raised rates 3 times in quick succession, in February, March, and again after that. By March, the cash rate was sitting at 4.10%, 3 hikes in less than 3 months. According to analysis from CanStar, 3 consecutive rate increases means a single-income buyer at average wages has lost roughly $36,000 in borrowing capacity since the start of this year. A dual-income couple has lost around $72,000, and on a typical $736,000 loan, each quarter-point increase adds about $120 a month to repayments. 3 of those in a row means many borrowers are absorbing close to $360 extra every single month compared to where they started in January. That's real money, and it's reshaping how people are behaving. Sellers started listing earlier in the season. Why? Because a lot of them can see where this is heading and want out before prices slide further. Some are investors who've done the math and decided it's not worth holding. Others are homeowners who are genuinely stretched by cost of living pressure, energy bills, groceries, transport costs, all climbing at the same time as mortgage repayments go up. Domain's chief residential economist, Dr. Nicola Powell, described the situation clearly. She said listing activity is seasonally strong for this time of year, but what we're seeing is sellers bringing homes to market earlier, likely to get ahead of a further slowdown in prices. At the same time, the federal budget on May 12th dropped a massive change on investors, announcing that from July 2027, negative gearing will no longer apply to established residential properties bought after budget night. The 50% capital gains tax discount is also being replaced. Investors who owned property before that date are grandfathered in, but anyone buying established homes from here on out is looking at a fundamentally different tax situation. That one announcement sent shockwaves through the investor community. Jeremy Fox from RT Edgar in Melbourne said his phone didn't stop. He described buyers and sellers as having a lot to digest all at once. The capital gains tax changes, the negative gearing reform, uncertainty about interest rates, and said it put shock into the system. So you've got sellers rushing to list, investors rethinking everything, and buyers doing what? They're pumping the brakes.
Here's where the buyer's side gets interesting. When sellers flood the market, normally you'd expect buyers to get excited. More homes to choose from, more leverage. And that is happening to an extent, but buyers are also scared. Higher rates mean they can borrow less. Cost of living pressure means they have less cash to play with. And the constant headlines about further rate hikes are making people hesitant to commit to the biggest purchase of their lives. Doug Driscoll, chief executive of Star Partners Real Estate Agency, said buyers are looking like deer in the headlights right now. He said people are waiting to see how the market plays out, spooked by rising costs, global uncertainty, and higher petrol prices on top of everything else. And the auction data confirms this. The clearance rate in Melbourne for the weekend of May 31st came in at 59.4%. The same weekend last year, that number was 71%. That's nearly 12 percentage points wiped off in 12 months. The long-run benchmark for what a balanced market looks like is around 65%. Melbourne has been running below that for weeks now. Tim Lawless, research director at CoreLogity, said the softer trend in values coincides directly with falling clearance rates and a surge in advertised supply. His point was that buyers have more choice, less urgency, and a clear edge at the negotiating table right now. And it's showing up in the pricing. Seller discounting in Melbourne is at a 9-month high. Vendors are currently cutting an average of 3% off their initial asking price to get deals done. For a home listed at $900,000, that's a $27,000 discount, not nothing. Nationally, new listings were up 22.4% year-on-year in the 4 weeks to early May, and the median vendor discount across all combined capitals widened to 3.1%, the highest it's been since 2022. CoreLogity confirmed that auction clearance has held below 60% nationally since mid-March, a level that is historically consistent with the early stages of broader price falls. And if you're curious about the actual price movements, Melbourne dwelling values fell 0.6% in April and another 0.8% in May, according to CoreLogity and PropTrack. Melbourne is now 2.9% below the peak it hit in November 2025, just 6 months ago. That's not a dramatic crash, but it is a clear and consistent downward trend. Before we go further, if you're finding this useful, hit subscribe. We break down property market updates like this regularly, what the data actually means, explained in plain English, no jargon. It takes 2 seconds, and it makes a real difference for the channel. Now back to it.
Not everyone is experiencing this the same way. Let's break it down. The premium end of the market is getting hit hardest. In suburbs like Toorak, Domain's December quarter data showed the median price down 14.2% annually, landing at $4.125 million. Why? Because when borrowing capacity shrinks, the pool of buyers who can qualify for a $3 or $4 million mortgage shrinks with it. At the luxury end of the market, even a small compression in how much people can borrow translates into a much smaller group of potential buyers. Meanwhile, the lower end of the market is holding up. CoreLogity's April data showed Melbourne's lower quartile barely moved, just 0.1% up. First home buyers and budget-conscious buyers are still active, particularly in outer suburbs where prices are lower and where state government incentive programs apply. Investors are in a unique and complicated spot. Those who bought before budget night in May are grandfathered, their negative gearing is protected, but anyone looking to buy an established investment property now is working with a fundamentally changed equation. Combank's analysis noted that removing negative gearing for established properties is roughly equivalent to a 90 to 155 basis point increase in investor mortgage rates in immediate cash flow terms. That's enormous. It's a significant disincentive for investors buying established stock. The one bright spot for investors? New builds remain fully exempt from the changes. Negative gearing stays intact for newly constructed properties, and investors can still access CGT discounts on new builds. So, what you'll likely see over the next 12 to 18 months is a gradual pivot, investors shifting toward off-the-plan apartments and newly constructed homes rather than established stock. For renters, things remain brutal. Melbourne's rental vacancy rate is sitting at just 1.4%, according to SQM Research's April 2026 data. Nationally, rents rose 0.6% in May alone, and annual rental growth is running at 5.7%. The rental crisis hasn't eased. If anything, higher rates are keeping would-be buyers renting for longer, which adds more pressure to an already stretched rental market.
So where does this go from here? The big question everyone is watching is what the RBA does at its next meeting. As of right now, CBA economists are forecasting rates to remain on hold for the rest of 2026. NAB has also come out saying they believe the RBA is done hiking and that rates will fall next year. But underlying inflation is still running at 3.4%, above the RBA's target range of 2 to 3%. So there's still a scenario where the RBA moves again. If rates hit 4.35%, which was considered live only weeks ago, SQM Research's Lewis Christopher had forecast Melbourne prices could fall between 4 and 9% over the course of the year under that scenario. That's the more pessimistic end of the range. The more balanced view, from Coretality's Tim Lawless, is that the likely path is some more softness, but not a dramatic fall. Employment is still solid, rental demand is firm. New housing supply is not keeping up with underlying need, and Melbourne's population is forecast to overtake Sydney's by 2032. That kind of structural demand doesn't disappear because of a short-term rate cycle. Dr. Andrew Wilson, chief economist at My Housing Market, put it bluntly when commenting on clearance rates. Clearance rates below 60% for consecutive weeks have historically been followed by price declines of 3 to 8% over the following 12 months. Melbourne has been there for weeks. The history says more softness is coming. But here's the other side of the coin. KPMG's property forecast actually has Melbourne growing 6.8% over 2026. Ray White's property outlook at the start of the year called Melbourne a better bet due to its underperformance over the last 5 years. The city is still roughly 20% cheaper than Sydney on an equivalent basis. For long-term investors and buyers thinking 5 to 10 years out, the current correction is starting to look like a window.
So here's where we land as of June 9, 2026. Melbourne has more homes for sale than at any point in 12 years. Sellers are discounting. Buyers are cautious. Auction rooms are quieter than they've been in years. 3 consecutive RBA rate hikes and the biggest change to property tax policy in 3 decades landed within weeks of each other, and the market felt both immediately. Whether this is a temporary pullback that resets into a new cycle or the start of something longer and harder depends on what happens with inflation and rates in the second half of this year. But for buyers right now, more choice, motivated sellers, and real room to negotiate. That combination hasn't existed in Melbourne for a long time. For sellers, price it right from day one. This is not a market that rewards wishful thinking. And for investors, the rules just changed. Established properties, new builds, tax strategy, all of it needs a fresh look. Everyone's watching what happens next. If this breakdown was useful, subscribe. We cover Australian property, economic data, and what it all actually means for regular people. And if you have questions about something we cover today, drop it in the comments. We read them.